Hello and welcome to Know Your Company. I'm Hiral Dadia and with me is Anushi Vakharia, and the company on KYC's radar today is Advait Energy Transmission. First up, let's quickly understand why are we talking to Advait and what do we as NDTV Profit want to know on behalf of the investors. First up, the current order book position, the kind of inflows that they are seeing and the execution timeline for all of these projects, because the key is execution. Second up, what is that contribution of new renewable energy segment looking like in the medium term, and the kind of impact it could have in terms of contribution and the margin prospects of the company. On number 3, we are also looking at the key updates that they will be giving us on capacity expansion and the kind of capex that will be required from here on, Anushi.
Right, so considering that new renewable energy segment just initiated from 2023 onwards, it's important to understand because the company is adding a lot more capacities, most of these incremental from FY27 onwards. So what would be the overall top line and the margin guidance in the medium term is also something that we should be quizzing the management about. Debt picture, considering more of these capex plans that we are looking at, more of these investments being considered for different manufacturing facilities is what we are looking at. What would be the outlook on that is also something that we should be tracking, right?
Absolutely. Now, let's quickly understand all about the company. What does Advait do? Engaged in providing products and solutions for power transmission and the renewable solution business. Now, they're transitioning from a consulting and trading company to actually a manufacturing company since 2014. And the goal that they set in 2014 was import substitution to start manufacturing. Apart from that, you're talking about power transmission, substation and telecommunication infrastructure in terms of the segments. And they're diversified into renewable energy as well in 2023. And that's what Anuji was talking about, because that is a new business and a lot of impetus that we're seeing when it comes to renewable energy as a segment as well.
In fact, this particular segment is expected to take over in terms of the revenue or the guidance also in the next forthcoming year. So it's interesting how this business shapes up. But let's just divide both of these segments and see firstly what the power transmission solutions exactly means. So this means they already have manufacturing facilities built for aluminium clad steel, optical ground wires, as well as emergency restoration systems. That's what we are seeing. Apart from that, some other products that we consider from this particular segments also include stringing tools. In fact, they have about 140 plus stringing tools manufacturing capabilities available. So that is another interesting play that we had. FY24, if we just see the mix also, 90% was the kind of mix that we saw from this particular segment. But renewable segment is, where we should see more of these contribution coming in from. So Hiral, that's the overall picture in terms of the current dominant segment that we are looking at.
Okay, so these are the various segments. Now let's look at the order book positioning as well. If you have to look at the overall order book, if you can just see the graphics, 757 crores is what they are sitting on in terms of the first quarter of FY26, grown substantially from FY24. We were just at around 204 odd crores when we saw in terms of FY24. Apart from that, if you see the previous years as well, they had actually started off at double digits at 71 odd crores. So good growth coming in there. And if you see the 3-year compounded growth in terms of the order book as well, that is absolutely strong at 92%. And in terms of the mix, around 68%, as Anushi was mentioning, coming in from power transmission solutions and 34% coming in from renewable energy. But don't be surprised if you see a switch that happens over here as well over the time, and given the kind of order book that they would be looking at from here on. But any recent developments, Anushi, that you've picked up?
Right, so just recently what we've seen is that the company has signed a MOU with Gujarat government, and this is for developing 2 of the projects that we are looking at, roughly around the size of 1,450 crore is what we've seen. Apart from that, there was also a couple of order wins in place. One, they've received around 80 crore plus of an order win from Power Grid as well. So these are the recent updates that we are seeing. It's the battery energy storage systems and the solar EPC order wins also, which would be in focus going forward, because that's where the company is eyeing more of growth coming in from.
So new ventures is something we need to watch out for. But let's quickly look at the key rating parameters that one should be watching out for. From the income statement, we will be looking at the balance sheet, cash flow. You have the return ratios, shareholding pattern, street credentials credentials, valuations, and the outlook. All of that we will be looking at. Anushi, let's look at the income statement from your lens now.
Right at the top, if you just look at the growth parameters in terms of how the revenue has shaped up as well as even the margins, we are looking at a 60% of a CAGR growth in this FY22 to FY25 period itself. And this is also, of course, aided by the new segment which is in place from FY23 onwards. Net profit also 62% of the growth multiple is what we are seeing. Of course, this is reflected by the order book growth also, as Hiral just pointed out, from 70 crore to 750 crore is the figure that we've seen. So that also continues to show revenue visibility forward. However, on the margin side in FY25, we did see that a bit of a dip to 16%, and this is on account of higher investments also taking in place, in particular with what's happening with the capacities. So, but overall, given these parameters that we are seeing and continuous 50% plus top line CAGR growth expected over the next few years, we are giving this metric a thumbs up.
Okay, let's look at the balance sheet. Now, the share capital has increased modestly over the last 2 years. The reserves and surplus, which is the retained profits, have also increased massively if you talk about FY23 to 25, and indicating strong profitability and retention in terms of earnings. Simultaneously, your borrowings have also gone up substantially. That's what you can see on your screens as well, from a moderate level in FY23 to a much higher level in FY24, and then further in FY25. Talking about liabilities, they have also ballooned, especially in FY25. And the company shows a strong growth story in the last 3 years, wherein the asset base has expanded, profits have increased, and the reserves are growing. However, this growth has come with rising liabilities and debt, which increases the risk from here on. The key to continued success will be maintaining healthy cash flow and managing the working capital well from here on. But a thumbs up so far.
Okay, in terms of where the cash flows are concerned, we've given this metric a neutral rating. What we've seen is that in FY24, there was a negative number that we'd seen, that is 10 crore minus is what we are looking at. And some bit of that attributable to the receivables that we are seeing. So we should continue to monitor how the receivables shape up for the business. Of course, you know, trade receivables will balloon up considering the kind of revenue growth also that is in context. Net cash flows, if we see from 8 crore in FY23, that is increased to 52 crore. So that figure remains on the healthier side. So overall, it's a neutral for cash flows if we are looking at.
Okay. Let's look at the return ratios. FY24 was a high point, both ROE and ROCE peaked in that year for the 3-year window, which suggests that the company deployed its capital very effectively that year, but likely due to strong revenue PAT growth relative to incremental capital employed. Now, there has been a slight pullback or normalization that has started to happen in FY25, where the return on equity and the return on capital employed has remained good. They've dropped relatively to FY24's highs, and this could actually stem for more capital being lined up with regards to new investments, possibly some bit of margin pressures that are coming in as well on the back of slower growth in efficiency. Now, having the ROCE near that, say, 25 to 30% kind of a range is strong, especially for a company which is into transmission, energy sectors, which actually often require heavy capital. Likewise, with the ROE as well in this range is very healthy. So the high ROCE in 2024 shows that the existing capital was actually leveraged well, but the dip that has come in 2025 signals that the new capital might be less efficiently used, or the returns from new assets haven't kicked in yet. So the monitoring how new investments and the capacity expansions translate into earnings from here on will be very important. And the growth versus equity dilution, with growing operations, they might need more capital. And if the equity raised, the ROE could get diluted. So that's the reason why a neutral rating.
Now, coming to the shareholding pattern, promoter stake continues to remain healthy. We are looking at around a 68% of a mix. This is as per the June 25 shareholding is what we are seeing, in comparison with about 74% stake that they held in March 23. But on the healthier side is what we are seeing. There have been a couple of preferential issues also which have taken place. Hence, we are looking at this dilution. In terms of FI and DI stake, it's almost negligible. FI stake is 0%, while DI is about 0.7%. However, in the public shareholding, if we check that one out, the company had been in focus just a few trading sessions before that on account of Vijay Kedia buying stake in this particular counter. In fact, what we are looking at is also Ashish Kacholia holding about 2.08% of stake as of June 25, in comparison with about 2.67% stake that he held in March 2025. So thumbs up, a neutral is what we've given shareholding as well.
Okay. In terms of the street credentials, now in the last 1 month, it's a downer. 8% is the kind of downtick that you've seen, and that's the only reason why we've given it a thumbs down, because otherwise it's not lost money for investors over the long term, but still minuscule returns coming in there.
Okay, coming to the valuation part of it, if you're just taking the 3-year average PE consideration, it's about 40 times of a multiple that we're seeing. Taking the current price multiple in picture, it's 61 times. So it is on the expensive side that we are seeing this particular share trading at, because if you look at the overall growth story in terms of how 50% of CAGR that we are looking at and all that has been majorly priced in. So compared to that, we are looking at relatively expensive valuations for this particular company. But here the outlook is interesting, right?
Absolutely. Let's look at the outlook, because the order book, which is up around 82% on a year-on-year basis in the first quarter, you're seeing a 50% compounded annual growth rate when you talk about the top line over the next 3 years as well, or few years, I would say. The expanding of the existing PTS manufacturing facility and the expansion overall when they're looking at for tools and ERS segment as well. Now, apart from that, they're eyeing a 1 gigawatt of BESS projects over the next 5 years, and that's a segment which is very hot right now in the market. They're setting up a new manufacturing unit as well in terms of Ahmedabad for manufacturing 300 megawatts of electrolyzer under the PLI scheme. They're expanding to 1 gigawatt electrolyzer manufacturing facility as well by 2030, which is a positive. So the future expansion plans are very strong. And when you talk about the fuel cell assembly and manufacturing facility, the operations are expected to begun by 2027. So again, a thumbs up when it comes to the outlook from here on. Let's quickly look at the final performance overall. If you see in terms of what the final performance is looking like, 2 thumbs up, your cash flow return ratios are a neutral. When you look at shareholding, street credentials, valuations, again a neutral, and the outlook is a thumbs up, which takes you to a 5.5 on 8, so which is also a very strong rating when it comes to Advait Energy. We'll quickly slip into a short break, and then we will be joined by the management of Advait Energy to talk to us about the business from here on the quick questions that NDTV Profit has for the management. Please stay tuned.
So as we were just discussing about Advait Energy Transitions earlier, I spoke to the management, Mr. Shalin Sheth, the promoter and MD of the company, and here's what he has to say about the company's new segment, new energy outlook going forward. Listen in. Right, so I'll start off with the major announcement that you've made in terms of this 1,450 crore worth of projects that we are seeing with Gujarat government. Talk to us about this, and where does that take your current order book to?
Our current order book, since as I mentioned you, our company is operating into 2 segments. One is a power transmission solution, and second is a new and renewable energy. So our order book going towards very healthy positions now. We have been focusing our order book very, very selectively. So because we are operating manufacturing, EPC, and then IPP 3 segment, so we've been growing cautiously in all the 3 segments based on our target. So currently our order book will be approaching towards 1,000 crores.
Okay, so 1,000 crore is the mark that we are looking at. Power transmission, as per the last presentation, if you look at 66% is the mix that we are seeing. New renewable energy, 34% is the mix that we are looking at. As per your commentary, you said that new renewable energy is expected to take over in the coming years versus power transmission. So just want to get an outlook in terms of what would be the business mix be going ahead in the next 2 to 3 years, if you can help us with that.
Yeah. As per our outlook, by year 2027-28, our NRE segment will take over the PTS segment. And as I told you, we're looking forward by 2,500 crores company by 2029-30. Again, in NRE segment, we have been focusing on new energy segment for the battery, BSS storage system, green hydrogen, and time and also we are providing the systems for the power transmission, solar, and battery system together.
So, Mr. Sheth, just want to get the overall order pipeline opportunity that we are seeing. I want to talk more about FY26 in context. You have 1,000 crore of order book. In beginning of FY20 of this fiscal year, we had seen some bit of that slowdown in terms of where the solar power projects are concerned. Just want to understand what's the kind of pace that you're looking in terms of these orders coming in place for this particular segment, and what's your overall target in terms of new inflows?
See, Arushi, we are into the products EPC and IPP
Right.
for the typical segmented power transition. And fortunately, all the business part, all the business scenario where we are operating to is having a very strong tailwind. So let me tell you, the order book is definitely is not the only phenomenon for us, because order book is possible, but we are looking forward for the quality orders. So from last 6 to 7 years, we have been growing with a rate of 40 to 50% per year. So we are looking forward this kind of growth, and we do not want to take any growth where our growth cycle is having the disturbance. So we'll be continuing the same performance in terms of order booking also.
Okay, so 50% is the CAGR rate that you've given for the next few years as well, in terms of where the top line is concerned. And this is on the back of some of your capacity expansion plans that you're looking at. If you just go through that, you're expanding your power transmission solutions manufacturing facility over there as well. Now coming to the new renewable energy segment, firstly, you're setting up a 300 megawatt of electrolyzers under the PLI scheme that we spoke about earlier. Along with that, you're also considering fuel cell expansion as well, which would with operations starting from around 27 as well. So from FY27, we are seeing a huge acceleration in terms of where your capacity additions are. So just want to understand what's the kind of overall capex plans that you have in mind, and when will we see these incremental revenues flowing through for the company?
We rolled out our capex plan from the year 2024-25, but we were looking forward very cautiously about the market trends, the market requirements, government policy. At the same time, we were keeping ourselves ready to go ahead when really the market is ready to take on from us. For our power transmission system, we have already put up the capex about 30 crores last year. We are putting additional budget of 75 crores for the next year, that is for the capex. And for NRE segment, we are looking forward for the budget of about 120 crores for the next year. We already put 40 crores this year. And then total our manufacturing capacity requirement of the capex for NRE segment will be about 300 to 400 crores. And PTS segment, the total capex will be about 100 to 120 crores, which will be taken care in next 2 years from our side. And we are looking forward for the incremental growth because of this capacity in both the sides.
Okay, so Mr. Sheth, you said that this will be taken care for the next 2 years. So I'm assuming that are you going to be looking for fundraising plans outside, or the internal accruals be sufficient enough for these capex that you're looking at?
For the year 25, 26 and 26, 27, we have tied up our fund requirements. So we may be open to look at the funds for the 27, 28, which may be primarily based on equity, or maybe we go with the debt.
Okay, so interesting outlook there from the management of Advait Energy Transitions, right? Hiral, what they're saying is 1,000 crore of an order book is what they're already looking at. Now, this is in comparison with a 500 crore of an order book that we saw in FY25. Along with that, in terms of capex also, they have huge plans over there, but for the next 2 years, even that is being taken care of. So as of FY28, they do not have such requirements in terms of looking outside for funds. But on the debt side, however, they'll be raising debt. So how that shapes up is something that we should be watching out for, correct?
Absolutely. The debt picture will become absolutely crucial to understand where the balance sheet and the return ratios go from here on. So interesting conversation, with the management of Advait Energy, but completely out of time. With that, it's a wrap on this edition of KYC from Anushi, the team that put the show together, and myself. Thanks for tuning in only on NDTV Profit for your profit.